The funny thing about a bull market is how quickly everyone turns into a genius. Your barber starts talking about rotating into growth.
Sorry, but
your group
costs
chat
have gone
suddenly
up
has a guy who called the
40%.
rally. That random stock you
40%?
bought out of
Are you
boredom,
serious?
up 40%. Obviously skill, nobody's nervous, nobody's confused, losses feel temporary, gains feel earned, and somehow the market has stopped being risky. It's just misunderstood. Charts only go up, bad news gets ignored, good news gets screenshots.
I
And every
figured it
win
out.
feels like proof that you finally figured it out. But there's a weird detail nobody likes to talk about. The louder the confidence gets, the less anyone can explain why they're winning. It feels smart. It looks smart. But something about it feels a little off. So here's the uncomfortable question everything else hinges on. Are people actually getting smarter in a bull market? Or does a bull market just make everyone look smart, not richer, not more confident? Smarter, because if prices are going up no matter what you buy, no matter when you buy, no matter how little you understand, then what exactly is being rewarded? Skill, discipline, insight, or just the fact that you showed up during the right weather? That single question quietly decides whether today's confidence is earned or borrowed from the market itself. And the answer isn't as flattering as most people think. To be fair, the mainstream belief makes total sense. People do work harder in bull markets. They do spend more time learning. They do take risks they wouldn't normally take. When prices are rising, feedback is instant. You try something, it works. You repeat it, it works again. That loop builds confidence fast. And confidence looks a lot like confidence. There's also real logic behind the optimism. Companies are growing, earnings look better, innovation feels visible, capital is flowing, jobs feel safer, money feels abundant. So when someone says, people aren't dumb, they're just finally being rewarded, it doesn't sound crazy. After all, markets are supposed to reward good decisions, right? Plus, nobody likes the alternative explanation. Admitting that luck plays a role feels uncomfortable, almost insulting, especially if you've made money. So the default story becomes simple and flattering. I studied. I took risk. I was early. I deserved this. And in a rising market, that story survives surprisingly well because nothing is pushing back against it. Not yet. Here's where the illusion starts to crack. In a strong bull market, most decisions get positive feedback, even bad ones. Buy a great company, you win. Buy a mediocre company, you still win. Buy something you don't understand at all, somehow also up. That's not skill being rewarded. That's environment overpowering decision quality. Think about it this way. If almost everyone is making money, then profit alone stops being proof of intelligence. There's a quiet statistic people hate. During major bull runs, the difference between careful investors and careless ones shrinks dramatically. Returns compress, outcomes cluster. Why? Because momentum lifts everything. It's like swimming with a strong current. Strong swimmers and weak swimmers all move fast, just in different postures. The dangerous part isn't that people make money. The dangerous part is why they think they made money. They start attributing outcomes to timing skill, stock picking ability, understanding macro, when in reality, the market removed friction. Risk doesn't disappear in bull markets, it just gets postponed. Volatility drops, corrections are shallow, mistakes don't hurt immediately, and when pain is delayed, learning breaks. That's the key. Good decision-making
Excellent work.
requires
You
feedback.
got every
But
single
bull
one
markets give
correct.
false feedback. Bad ideas don't
The
fail
market
fast.
is soaring.
Leverage doesn't punish immediately. Overconfidence doesn't get checked. So people don't adapt, they double down. What looks like growing intelligence is often just confidence scaling faster than understanding. And that gap stays invisible until the environment changes. Because when the tide finally stops rising, the market doesn't just take money back. It reveals who never learned how to swim without
was
the
the
current.
dawn of
This
a
isn't
new
new.
era.
We've
Companies
watched this
with little
exact
more than a
movie
website
before.
address were
In the late
suddenly worth
1990s,
millions.
during the dot-com boom,
Millions.
the market felt
an
unstoppable.
absolute steal.
If a company
Sold to
had
the
.com in
gentleman
its
right
name,
here. We
it
have
didn't
a
need
deal.
profits, it just needed a story. People quit stable jobs to trade full-time. Day traders became celebrities. Regular investors felt behind if they weren't all in. And just like every bull market, intelligence felt contagious. The Nasdaq doubled in just a few years. Stocks went up after bad earnings. Valuations stopped mattering because prices kept rising anyway. Sound familiar? Back then, investors didn't say, "This is luck." They said things like, "Old valuation models don't apply anymore. You just don't understand. The internet." This time is different. Even Alan Greenspan warned about irrational exuberance and was mostly ignored. And here's the important part. A lot of people were smart. They researched, they analyzed. They weren't reckless gamblers, but the structure of the market rewarded participation, not precision. When the bubble finally burst in 2000, the crash didn't just erase money, it erased confidence narratives. People didn't suddenly become stupid overnight. They simply lost the environment that had been doing most of the work for them. The same portfolios that looked brilliant in 1999 looked reckless in 2001 without changing a single holding. That's the pattern. Bull markets don't create intelligence. They hide the difference between skill and favorable conditions. And history keeps reminding us of this, right after everyone forgets it again. Let's strip the charts away and talk like normal humans. A bull market is basically life on easy mode. It's like driving downhill with a tailwind. You can take your hands off the wheel for a second and still feel in control. That doesn't mean you're a great driver. It means gravity is helping.
Delicious.
Imagine learning to cook when every dish tastes good no matter what you do. Too much salt? Still fine. Forgotten ingredient? Still edible. Would you actually learn how to cook, or would you just assume you're talented? That's what a bull market does to investors. It removes consequences. People think they're improving because results are improving. But improvement without resistance is just comfort. Here's another one. Think about a group project where everyone gets an A regardless of effort. Some people worked hard, some barely showed up. But everyone walks away thinking, "I did my part." That's markets in a strong uptrend. Now add leverage. Borrowing money in a bull market feels genius. Returns get magnified. Losses feel theoretical. It's like running downhill and bragging about your speed until the slope flattens. And here's the most dangerous illusion of all. Pattern recognition without causation.
Tech always
People start
goes
connecting
up.
dots that aren't connected. This stock always bounces after earnings. Tech always recovers fastest. Every dip is a buying opportunity. Those aren't insights, they're observations from a specific environment. Change the environment, and the rules vanish. Bull markets reward behavior that looks intelligent, being aggressive, concentrating bets, ignoring downside, extrapolating recent success. But those behaviors don't scale across time. They only scale across good conditions. That's why people feel shocked later. They didn't suddenly get worse. The game just stopped forgiving mistakes. Real understanding isn't tested when everything works. It's tested when nothing works the way it used to. And that's why bull markets don't teach people how to invest. They teach people how to feel smart. Let's go back to the question we parked earlier. Are people actually getting smarter in a bull market? Or does a bull market just make everyone look smart? After everything we've walked through, the answer starts to feel uncomfortable. Because intelligence doesn't usually show up as confidence. It shows up as restraint, as uncertainty, as knowing what you don't know. But bull markets don't reward those traits. They reward participation. They reward being early, not being right. They reward exposure, not understanding. So the market ends up selecting for behavior that resembles intelligence without requiring it. That's why the same people who sound brilliant at the top sound confused when conditions change. Their frameworks didn't break. They were never really tested. The bull market acted like a filter that let almost everything through. Good ideas, bad ideas, lucky ideas, all mixed together. And when outcomes converge, people mistake results for reasoning. This is why debates get louder near market peaks. Everyone has receipts. Everyone has screenshots. Everyone has proof. But proof of what? That something worked? Or that it was understood? The hardest part is this. You can't tell from inside a bull market whether your success came from skill or from structure. The environment does too much of the heavy lifting. So when people say, everyone's smarter now, what they're really noticing is this. Mistakes just haven't been charged interest yet. A bull market doesn't lie to you. It just doesn't tell you the whole truth. It shows you what works, but hides why it works and for how long. That's why these periods feel so convincing. Success feels repeatable, confidence feels justified, and doubt feels unnecessary. Until it isn't. Markets have a quiet way of teaching lessons late. They let narratives build. They let identities form around performance. They let people confuse favorable conditions with personal growth. And then eventually they change the rules. Not to punish, not to be fair, just to remind everyone that environment matters more than ego. The uncomfortable takeaway isn't that bull markets make people foolish, it's that they delay the moment when understanding gets tested. And most people only realize that test existed after they've already answered it. So maybe the real risk in a bull market isn't overvaluation or volatility. Maybe it's believing that the version of you who wins easily is the same version who survives when things stop being easy. Because feeling smart is cheap, understanding is expensive, and the market always sends the bill, just not right away.